what we're going to do today. We have a presentation, which I'm really excited to see. And what I'm going to do is I'm going to come around and I'm going to take a look at your pre-tests and see where they are. In the last class, I would probably say at least 66% of the class have it totally done. I would say maybe another 10 had it done but had a few gaps in it, and there was a few people that just didn't attempt it. So I'll take a look at it, see where you guys are, give you some suggestions, some recommendations. I'll go over any of the gaps that you have in your pre-tests. Some of the questions are like how do you determine the dependent and independent variable? How do you solve for multilinearity? These are some of the questions. How do you calculate the intrinsic values? I'll go over that with you too. And then what I'll do is I'll hand out some problems. Okay, and next Thursday you have a week to work on them, and then next week you come in and you put the problems up on the board, and we work through the problems together. Okay, and then I think that's it. And then try to make an attempt at the memo. My recommendation is maybe scan it, get it into a PDF, convert it to Word, and then work with it that way to get the majority of the formatting done, so you're not spending all your time being frustrated with the formatting. Read a bunch of articles, update the data. If you got your own view of where you think the pricing is going to go on stocks, up or down by some amount over the next 3 to 6 months, put that in. If they're going to go up, use that set of trades. If they're going to go down, use the other set of trades, and then start working with the memos and try to get me, maybe by the end of next week, some kind of memo shot. Just get going. Just break the ice. Get around the procrastination. Okay. So, and I'll help you out all I can. So when you guys are ready, I'm going to turn off these lights here, and then I'm going to walk around. I'm going to take a look at what everybody's done.
Okay, all right. This is chapter 4, analyzing financial statements. Okay. I'm Claire, this is Cassidy, and this is Michelle. Okay, so perspectives on financial statement analysis. So there's 3 different things. Stockholders focus on the net cash flow, risk, rate of return, and the market value of the firm's stock. Managers focus on the rate of return, efficient use of assets, controlling costs, increasing net cash flows, increasing the market value of the firm's stock, and job security. And lastly, creditors focus on the predictability of revenues and expenses, the ability to meet short-term obligations, the ability to make loans and payment at schedules, and avoid change in risk. So the guidelines for financial statement analysis are, firstly, understand the perspective, stockholder, manager, and creditor. Use audited financial statements. Use 3 to 5 year of statements to enable trend analysis and to benchmark to competitors of smaller sizes with similar products and services. Common size financial statements. Common size financial statements show the dollar of each item and percentage of the reference value. Common size balance sheet may use total assets of the reference value. Each item is expressed as the percentage of total assets. And common size income statement may use net sales and reference value. Each item is expressed as percentage of net sales. The common size balance sheet standardizes the amount in the balance sheet account by converting the dollar value to each item to its percentage of total assets. Dollar value on the regular balance sheet provides information on the total number of dollars associated with the balance sheet account, and percentage values on common size balance sheet provide the information of relative size importance of the dollar associated with the balance sheet account.
The common size income statement. The most useful way to compare a common size income statement is to express each account as a percentage of net sales. Each expense is interpreted as a cost incurred to generate $1 in sales.
And then show it to you.
Categories of common financial ratios are liquidity ratios, efficiency ratios, leverage ratios, profit profitability ratios, and market value ratios. Short-term liquidity ratios. Liquidity ratios indicates a firm's ability to pay short-term obligations with short-term assets without endangering the firm. In general, higher ratios are a favorable indicator. So current ratio is current assets over current liabilities, and a quick ratio is current assets minus inventory over current liabilities. Efficiency ratios indicate a firm's ability to use assets to produce sales. These are also called turnover ratios. In general, higher numbers are a favorable indicator. For days sales and inventory, however, a lower number is favorable. Inventory turnover is cost of goods sold over inventory. Days sales and inventory is 365 days over inventory turnover. Efficiency ratios are accounts receivable turnover, which is net sales over accounts receivable. Days sales outstanding is 365 days over accounts receivable turnover. And then we have asset turnover ratios, which is total asset turnover, which is net sales over total assets. And then fixed asset turnover is net sales over net fixed assets. Then we have leverage ratios, which indicate whether a firm is using the appropriate amount of debt financing. In general, higher ratios indicate greater potential return and greater bankruptcy risk. Total debt ratio is total debt over total assets. Debt to equity ratio is total debt over total equity. And equity multiplier is total assets over total equity.
Coverage ratios are for the following ratios. A higher number generally indicates less bankruptcy risk and possibly lower potential return. First equation is times interest earned, which is earnings before interest and tax divided by interest expense. And cash coverage is earnings before interest, tax, depreciation, and amortization, divided by interest expense. Profitability ratios indicate whether a firm is generating adequate profit from its assets. In general, higher ratios indicate better performance. The gross profit margin is equal to net sales minus cost of goods sold divided by net sales. The operating profit margin is earnings before interest and tax divided by net sales. Some more profitability ratios. Net profit margin is equal to net income divided by net sales. Earnings before interest and tax, return on assets is earnings return on assets divided by earnings before interest and tax divided by is equal to return on assets is equal to net income divided by total assets, and return on equity is equal to net income divided by total equity. Market value ratios indicate how the market is valuing the firm's equity. Higher ratios indicate greater shareholder wealth. Earnings per share is equal to net income divided by shares outstanding. Price to earnings ratio is price per share divided by earnings per share. And market to book ratio is the market value of equity per share divided by book value of equity per share. The DuPont system is a diagnostic tool for evaluating a firm's financial health. Uses related ratios that link the balance sheet and income statement. It's based on two equations that connect the firm's return on assets and return on equity. This is used by management and sales holders to understand factors that drive the return on equity. Return on assets is equal to net profit margin times total asset turnover, and return on equity is equal to return on assets times equity multiplier.
Okay, so we wrote down 3 of the homework problems from this chapter. So the first one is, why is it important to look at the firm's historical financial statements? And the answer is one does a ratio analysis on the firm. It is important to do the analysis over a 3 to 5 year period. Looking at the historical financial statements allows one to see the trends on the various ratios, whether or not they are improving, worsening, or staying the same.
The next question is, what is the purpose of the dew-point system analysis? The purpose of the dew-point system analysis is to determine the company's financial health. It breaks down return on equity into 3 parts: profit margin, total asset turnover, and financial leverage. If return on asset is unsatisfactory, the dew point identity helps locate which part of the business is underperforming.
And lastly, what are the limitations on traditional financial statement analysis? The answer is the main problems with financial statement analysis are that since it's based on book values, which is historical data, it may not reflect a firm's true economic condition, and there is a lack of economic underpinning for much of the decision rules. It is difficult to say a current ratio of 2.2 is good or that one ratio is more important than another. That's it.
Take me on. Yeah, the definition for the different types of business. And don't forget your name. Change it up. Put a little more definition in there. Okay, keep going. And we'll go on to specific. And then you can work with others too. Move through the process. Yeah, we'll do that. I'll go over it.
He's gonna put an A.
Just like a reasonable little thing. Like, yeah, yours is fuzzy, so fuzzy. Good. So yeah. Oh yeah, we just came in. Yeah, they were back. He was like, I'm gonna give you these questions, and I was like, what questions? How?
But it's just funny because like Eleanor just I think it's just like what I'm thinking because he has the answers to it. Yeah, I'm just gonna put it that way. I'm not gonna write it. I'm not gonna be trying to write again. Or like copy and paste it just still a little bit. Yeah, like I'm not really sure. I'm not asking her if we did. And then she was like that just I'm not sure, just make sure. Okay. I saw it because I was look at mine. I'm just gonna watch the video tonight. It's not me. But we can. You just
No, except for the first part of the pre-test. The first part of the pre-test and investments is this pre-test. And then the last part of the pre-test and investments is the quiz for this class. Okay. Awesome. Excellent. Nice job. Thank you. You do? And then you gotta put the yeah. I zero the margin.
I know, like, to me.
Then you won't run the direct feed.
Oh my. Oh yeah, my. It's ridiculous. There's so many
When we gave the examples in the balance sheet,
Yeah.
stuff like that, does it matter which one?
No, yeah. I just want you to just review the balance sheet.
And did it have to,
It doesn't have to, I just want you to review what a balance sheet and income statement is.
I'm not worried about
Because you probably have to look at I mean, since you're financial accountant, okay? All right. Does anybody have any questions? Cross-sectional and time series regression? Yeah. Okay, I'll go over that. A lot of the same questions were in the last class, okay? All right, so I'm gonna go over here. There's two types of regressions. There's cross-sectional regression and there's time series regression. Now, from my experience, and I've worked on some projects before where I was trying to forecast. What was I trying to forecast? I did a research report where I was trying to forecast price earnings multiples for our company, okay? But I didn't have enough history for our company. We didn't have enough data going back in time. So I couldn't use time series regression. But I did have the data for the top 20 companies within our sector. So I could use the same variables that I would otherwise use in a time series regression to forecast price earnings multiples. But since I didn't have enough time series data, I used cross-sectional regression. So instead of using time here, I was using firms. So I had 20 firms that were in the apartment sector, within my sector, same company type of sector firms. So here was the 20 firms. This is not 20 time periods, it's 20 firms. So it's one time period, 20 firms. Time series regression is one firm, data over time. Cross-section, one time period, multiple firms. Time series regression, one firm, multiple time periods. Okay? So what I did was I found the 20 firms. I was trying to forecast, in this case, I was doing price earnings multiples, or PE, the price of the share divided by the earnings per share. Gives me my multiple. And I was asked by the president of the company to forecast our price earnings multiple going forward so that he could forecast what the share price was going to be. So we knew what our earnings per share was for next year. We didn't know what the multiple would be. And if we know what the earnings per share is next year, we multiply it by the multiple that we forecasted, I can predict where the stock price is going to go next year. Is that important? Yeah, absolutely. Because he wants to know, because he's got stock options with an exercise price. And if the stock price is trading at 50, and he can exercise it at 50, but I'm forecasting that the stock price is going to go to 100, he can exercise his call options at $50 and then sell the shares at 100. Okay, so it was an extremely important question that he asked me. Okay, So that's the difference between the two, okay? And then, what else? Then there was, I guess the other question was, what was the dependent variable? How do you determine the dependent variable? Well, somebody's gonna tell you what we need to forecast. Okay, usually gonna be a senior level executive person that's gonna tell you what it is that they need to forecast. Or you're gonna have to be a consultant, okay? You're hired as a consultant, this happens to me all the time. I'm hired as a consultant. Professor Souza, you know, I've got a startup company. We need some guidance and some projections. We really don't know what metrics we need to be focusing on, you know, over the next 2 years to really drive value for the firm. So I'm saying, well, we need to figure out what the sales projections are gonna be, what the production levels are gonna be, what the financing costs are gonna be. We need revenue growth, earnings growth, we need to know all that stuff. It's like, great, thank you for guiding. Do you know how to predict that stuff? Yes, I do. I've looked at the research, I've talked to people, I've built the models, I can help you do these forecasts and help guide you and do those projections. Okay, how do you determine the independent variables? Okay, so for my research, I was trying to predict price earnings multiples for a company. One of the main variables was earnings per share next year forecast by analysts. So they were consensus estimates, 1 year consensus estimates, forward-looking earnings that all of the equity analysts had forecast what our earnings were going to be next year. Okay? So I took that survey and I plopped it in here. Okay? Another major variable that talked about or determined multiples for the firm was leverage. Leverage or into equity ratios. So as the firm leveraged up the firm, the multiples would increase. But as the leverage increased past a certain point, then it actually had a negative effect on the multiples. So we put that in the model too. The other variable that I thought was kind of interesting was daily float, or trading volume, or liquidity. So how much volume of shares traded in our stock on a daily basis? If they had low liquidity, then the multiples were lower. If there was high liquidity, there was a lot of trading in our stock, then the multiples would go up. So those were the independent variables that I had come up with using internal validation methods by talking to all the experts within the firm. And those are the factors that they said, yes, we agree with you, those are the factors that would drive multiples up and down. I also went to the literature, the industry literature, by industry firms that have been following our stock and been following similar companies like ours. I read through the literature, the industry research, to validate these variables through external validation. And I went to the library and I looked up all of the academic research papers that have been published around what drives PE multiples for corporations, and looked at their models and looked at their variables and used internal and external validity to basically construct a model to then be able to forecast the PE multiples for our firm. The problem was I didn't have enough historical data, so I used cross-sectional regression using 20 firms instead of 20 time periods. I ran the regression. I looked at the T statistics for each of the independent variables. I looked at the F statistic for the overall model's ability to predict. I looked at the mean squared errors to try to minimize. Then I looked at that. I looked at the P statistic. I looked at other regression diagnostics to then see if my model was doing a good job of predicting. Once the regression diagnostics were done, then what I did was I forecasted. Went in and did a forecast on daily flow for our stock. I went ahead and forecasted the debt to equity ratio. I went ahead and forecasted the earnings per share for our company and was able to forecast what our multiple was going to be over the next year. So I used cross-sectional regression analysis. One of the questions on the exam is how would you use the two regressions? I use cross-sectional regression to get the coefficients and then pump in the time series data to get the multiples. So I use cross-sectional regression as an interim solution until we had enough data going back far enough to then switch to the time series regression to then do the forecasts for the multiple. Okay, so it's really powerful. I mean, you would never know to do that unless you had worked, in forecasting within the firm. So the cross-sectional regression is an interim solution to the long-term problem of not having enough data. Okay, so I think that answers one of those questions on the pre-test. What was the other questions? Oh, how do you determine the dependent variables? They're going to tell you, or you're going to have experience and you're going to guide them. How do you determine the independent variables? You're going to ask individuals within the firm that have experience in knowing what drives these multiples, and you're going to do a survey from them, and they're going to tell you. And then you're going to go do the research, industry research and the academic research to validate those variables also. Let's say you have two variables in your model that are highly correlated to each other and also highly correlated to the dependent variable. Well, you don't need both of them in there because you have multicollinearity issues. So how do you decide which one to keep and which one to throw out? The one you keep is the one that's been cited the most in the industry literature, in the academic literature, and maybe even mentioned the most, by people inside the firm, providing you with both external validity and external validity. So the one that's been cited the most has been cited the most over time, which builds the literature that builds the theory that justifies that this variable should be in the model. Even though this one does a better job statistically, this one has been validated theoretically and through the literature consistently over time. Thereby I throw out that one and I keep this one. Okay. So I'm giving you some of the answers to these questions. What was the other one too? What were some of the other questions that you had? I think those were most of them. Go ahead.
The question under that where the variables, where it says, what are the tests of variable and model statistical significance in
so,
regression tests?
Yeah, exactly. So the testing the independent variables' ability to predict the dependent variable is going to be the T statistic, or the T stat. Okay? And then the ability to test the model capability and ability to predict the dependent variable is going to be your F stat, your F statistic. I can also use another statistic I can use for independent variables against the dependent variable is I can use a correlation. I can use the correlation coefficient. And an extension of the correlation coefficient for the independent variables is the adjusted R squared, which actually looks at the total model variables correlation with the dependent variable. So that's your adjusted R squared. And there are other diagnostics, the p-values and Durbin-Watsons and other regression diagnostics that you would get from a standard regression diagnostic table in Excel or R or Python or whatever, MATLAB or whatever statistical application that you're using. Okay. Did that answer your question? Okay. Anybody else? Yes.
Question 9 with the one at the bottom that says what type of risk can be diversified away and how would you do this?
Okay, great. Great question. I'll do it over here. Thank you. So in the book, basically it's N, this is the standard deviation of your portfolio. So this is the number of stocks in your portfolio. So 0 stocks in the portfolio, N number of stocks in your portfolio. Okay, so you're starting to build your portfolio and you're starting to add more stocks to the portfolio. What happens is we can lower the portfolio standard deviation significantly by adding more stocks to the portfolio. And it's the same thing, it could be adding more bonds to your bond portfolio, adding more different types of real estate assets in different locations by different property sectors in your portfolio. So as you add more assets to your portfolio, whose returns have low, no, or negative correlation with each other, it's going to eliminate the unsystematic risk. Or industry specific risk or business specific risk. These are all interchangeable terminology. Okay? So as you're building a portfolio, and it could be a portfolio for a company too. Company, I have one line of business. We started with with basically let's say a marketplace, like an eBay type approach. Then we launched a new product line in consulting. We launched a new product line, actually manufacturing cell phones. We launched another product line, in manufacturing. Those product lines, the revenues that are generated from those multiple product lines, the growth of those revenues and the level of those revenues are going to have low correlation with each other. So you diversified your firm by offering different types of products because they're not perfectly correlating with each other. So if that segment of the industry goes down, it's not going to take down your firm because you've got other products that are generating revenues that are not correlated to all the other product lines of your business. It's the same thing with stocks. I'm adding stocks to my portfolio whose returns have low, no, or negative correlation with each other. So if I'm adding stocks to my portfolio whose returns are perfectly correlated with each other, then I'm getting no diversification whatsoever. Okay. So as we know, the correlations on the worst scenarios, they're perfectly correlated, and the correlation is 1 or 100%. If I want diversification within my portfolio, I want stocks in my portfolio. I want to add stocks that have low correlation with the other stocks. In the portfolio. Or I want to add stocks in the portfolio that have 0 correlation with each other. And if I want perfect, this blue line is 0. And if I want perfect inverse correlation, perfect diversification, perfect offsetting, then I'm going to add stocks to the portfolio with negative correlations in returns with the other stocks within the portfolio. So if I add stocks to the portfolio with low, no, or negative correlation with returns with the other stocks, I'm going to be able to diversify away the unsystematic, the industry, and the business-specific risks, so that the only risk that's left is the systematic risk. Now, systematic risk is also called systemic risk. So systemic risk is, institutional risk. When the financial crisis hit, everybody went down. That's it. Okay. This could also be macroeconomic, political, and policy, and market. So these are the risks I can't diversify away. I can't manage through portfolio diversification. This is the risks that are going to be left, okay, that I can't diversify away. That's kind of a big deal because over the last, and I'll throw a little footnote in here, over the last 10 years or really 20 years, there's just been more financial crises and more crises in the world. So you as managers are actually looking at managing in an environment, business environment, with higher systematic risk, okay? So how do you manage higher systematic risk? My recommendations to my clients are what you do is you take on more unsystematic risk, business-specific risk. Focus on your clients, focus on your markets, focus on your technology, focus on your people, and push down the unsystematic risk by taking on even more unsystematic risk. And to do that, you have to be a really good manager. So your abilities now, your capabilities now to become really good managers, the standards are a lot higher because you're going to be working in an economic environment, in an industry and market environment that's even more volatile and more risky than historically speaking. So that could be exciting for you on one level, but it just means that you're going to have to really focus, and be really good at what you do, and be really good, and start thinking towards senior level executive positions to be able to communicate your capabilities to do that stuff. And that's a long answer to a short question. Okay, you're welcome. Anybody else have any questions? T's and F's. Risk-adjusted rates of return are just the inverse of the coefficient of variation. Instead of standard deviation divided by the expected return, it's the expected return divided by standard deviation. You guys should be writing like mad if I were you guys. Okay? The people who didn't, make an attempt at this, I would be writing like mad. Okay? The portfolio standard deviations, not the standard deviation equation, but it's the portfolio standard deviation equation. And everybody did a really good job on there. I think one person didn't have the correlation coefficient. The correlation coefficient is just the covariant, the covariance divided by the standard deviations of the two. So, and they normalize, the correlation normalizes it, so it sets it between maximum 1 and negative 1. Okay. And then the portfolio standard deviation, remember if the covariance or the correlation rise or is high, then the portfolio standard deviation is going to rise and be high. If the covariance and the correlation coefficient is low or is falling, then the portfolio standard deviation is going to be low or fall. Okay, so it's a positive relationship between the two. Okay, what is the value of using regression techniques? Forecasting. Okay, being able to look at relationships and look at variables that drive the dependent variable so you can forecast with accuracy. I think we went over cross-section and time series. How do you determine the dependent variable? They're going to tell you, or you as the consultant are going to advise them on what they should be measuring. And then independent variables, you do survey internally the experts and then look towards the industry in the peer-reviewed journal articles. How do you test the model significance? T's. The T for the individual variables, the correlation for individual variables, and the F and the adjusted R-square for the model itself. Solving for multilinearity, again, the one that's cited the most in the literature. Internal validity for people inside the firm, experts, validating your approach, your model, your variables. Externals, industry research, academic research. We just answered 9, and that. Assets, liability, all that stuff's pretty easy. Some people didn't get the debt to total market cap, or the weighted average cost of capital, or the CAPM. I'll do that when I do the intrinsic valuation methods. I'll go through those right now, okay, to give you a little bit more. I was just looking for theoretical constructs of the models, but I'll go through them with you now in a little bit more detail, which will help you out on the exam. Okay, and then we'll go to the exam and start working through the exam. Okay, so let's talk about the valuation models, the intrinsic valuation models. There are multiple intrinsic valuation models that are used. I focus mainly on 4 of them in this class. The perpetuity model, the Gordon growth model, the multiple approach, and the discounted cash flow. Okay, and I'll go through examples of that today. The perpetuity model is pretty straightforward. This is my nomenclature. Okay, the book has different nomenclature. If you look at different books, they'll use different nomenclature. This is Larry's. Okay. CFO is the cash flow. Okay, is the numerator, and then the discount rate is the denominator. Okay. So the perpetuity model is pretty simple. It's just next year's cash flow, and cash flow can be defined in many ways. It could be either the dividends per share that are going to be paid to the stockholders. It could be earnings per share for the company. It could be EBITDA or free cash flow per share for next year. We could use those if we're doing stock valuations. It could also be total earnings of the company next year, or total EBITDA for the firm next year, which is the free cash flow, if I want to value the entity at the entity level. So these models can be used to value shares, entities, real estate, bonds. They're all using basically the same methodologies. So we don't use this year or last year's cash flow, we use next year's cash flow. Okay? And this little line over here, over on top of the cash flow, means that the cash flow is going to remain constant forever. So if it's paying a dividend of $10 or earnings of $10 per share, it's going to be $10 forever. Okay? And the model decomposes to just next year's cash flow divided by the discount rate. Now the question is, what is the discount rate? This is a discounted cash flow model. This is a perpetuity model. Okay? It's perpetuity because the cash flows are going to remain flat forever. So what is the discount rate in which you're going to discount the cash flow to get the value using the perpetuity model? Now I can use many different discount rates depending on what I'm valuing. I can use my expected return. So I'm looking at a stock that pays $10. I expect a 10% rate of return on all of my investments. The value of the stock is going to be worth $100. Okay. So I can put that, the discount rate could be what return I'm expecting or what return I require. So it could be the expected or the required rate of return. Required rate of return. Well, if I'm an investor, I could just say I want 10%, or I could say I'm going to calculate my expected return on the equity by using the capital asset pricing model, or CAPM. So I can take the risk-free rate, let's say it's the 10-year treasury, 3%, plus the beta, and again, the beta is just like the correlation coefficient. If the beta for the firm is 1, that means that the stock returns move with the S&P 500 with the market. If the beta is greater than 1, then the returns move more than the market. If the beta is 0, then there's no relationship. And if the beta is negative, the returns move in the opposite direction. Most stock betas are maybe range from 0.6, 0.7 to maybe 3. Okay? High-tech companies, startup companies, newly issued are going to have very high betas. Real estate companies, publicly traded, are going to have betas close to 1. Very large corporations that trade on the exchange are going to have betas of 1. And then over-levered firms that are not really large firms, but maybe medium-sized firms, may have betas of about 1.2 or 1.3, something like that. So the ranges the betas are range-bound, okay? And then you're going to multiply the betas by the return on the market minus the risk-free rate. This is going to calculate my expected return on my equity investment as me as the investor, okay? But if I'm a firm and I'm forecasting the free cash flow, because we're looking to buy a company, we don't think the free cash flow is going to grow in the future, then I'm going to take the capital asset pricing model, and not only does it calculates the expected return on the equity from an investor standpoint, it also calculates the expected cost of equity from the firm's perspective. So it's the same equation with different perspectives. I can use that. If I'm buying the firm, I'm going to use CAPM as the discount rate because I'm the firm buying the company. If I'm an investor buying the shares in this company, I can use CAPM to calculate the expected return on the equity for me as the investor. So the CAPM is very versatile in that way. And that's going to be the cost of equity. I can also use the weighted average cost of capital. So I'm looking to buy a company. I don't think the cash flows are going to grow into the future. I can calculate the weighted average cost of capital and use that as the discount rate to discount the cash flow to get the value of the firm. What is the weighted average cost of capital? Well, it is the weight of the equity times the cost of the equity using the capital asset pricing model. Got it. Plus the weight of the debt times the cost of the debt multiplied by 1 minus the tax rate, because the interest on the bonds that are issued by the firms are tax deductible, so that interest charge is a tax shield to the company. For the cost of the debt, how do you come up with the cost of the debt? There are many ways to do it, and you'll be learning how to calculate yield to maturities on bonds and interest rates on bonds. This is going to be the yield to maturity on the bond will determine the cost of the debt. Okay. What is for example, what is the weight of the debt? Well, what I can do is I can use either market value or book value. And let's say I use market value to get these weights. I can go out and look at all the bonds that were issued by the company, the number of bonds multiplied by the price of the bonds to get the market value of the debt. This is the market value of the debt. Then I can take the market value of the debt and divide it by the market value of the equity plus the market value of the debt. And how do you calculate the market value of the equity? Pretty simple. I take the shares outstanding, and I multiply it by the share prices of the stock. So that's the total shares outstanding times the share price. It's going to give me the market value of the equity. The bonds outstanding times the price of the bonds is going to give me the market value of the debt. So the market value of the equity plus the market value of the debt is the total market cap, or total market capitalization of the firm, the value of both their debt and the equity. So if I take the market value of the debt and divide it by the total market value, market cap of the firm, I'm going to get the weight of the debt. And if I take 1 minus the weight of the debt, I get the weight of the equity. Okay, so So it could be, it's very simple. You'll be working these equations in class. The capital structure, the weights, for most companies that trade on the New York Stock Exchange is 70-30. 70% of their long-term liabilities are made up of debt, and 30% of their long-term liabilities are made up of owner's equity. Okay? So this is how most firms are leveraged, and other firms are either more conservative or more aggressive in leveraging their assets. Okay? So you can calculate the weighted average cost of capital, and that could become the discount rate too. Okay? So it depends on who you are. Are you an investor or are you a firm in doing the valuations? So I gave an example. You're expecting a 10% earnings per share for next year. Your expected return is 10%. Therefore, the value of the share is $100. Very simple. Another way to do it, to do a valuation, is the Gordon growth model. The Gordon growth model is basically it's just like the perpetuity model, but instead of assuming that the cash flows are going to remain flat forever, they're assumed to grow at a constant rate forever. So what you're going to do is you're going to subtract from the discount rate what you think the growth rate is going to be for this cash flow forever into the future. Okay? So it's I minus G is going to be Gordon growth. In Gordon growth, for an example, over here, we're expecting 10% next year in earnings per share. Our expected return is, or required return is 20%. We think that the earnings per share is going to grow at 10% per year forever. 10 divided by 0.1 is going to give us $100. So that's the Gordon growth is just a modification of the perpetuity. Just assumes that the cash flows are going to grow at a constant rate. So again, very simplistic valuation approach. Okay. The next approach is going to be the multiple approach. Now, the multiple approach, we could be using many types of multiples depending on what we're trying to value. If we're valuing a stock, we're going to use stock price divided by earnings per share, or the PE multiple. If we're valuing a firm, we're going to use the value or the sales price of that firm divided by the earnings for the free cash flow. Okay. If I'm in investment banking, I've seen a bunch of deals go down. I know what the transactions were. I know what the free cash flows were. I can take the sales price or the value of the firm divided by the free cash flow to get a multiple. You then multiply the multiple by the free cash flow projections for our firm to figure out what the value of our firm is going to be. Or what I can do is I can look at stock prices divided by earnings per share for other companies similar to ours in the marketplace today. Average them out or pick the best companies' multiples and apply their multiples to our earnings per share projection for next year to get the value of our share next year. So there's different approaches. I can also calculate multiples by using the perpetuity model. Instead of cash flow, I use 1 divided by the discount rate. It's going to give me a multiple. So 1 divided by 10% or 1 divided by 0.1 gives me 10 times. I can do the same thing with the Gordon growth. 1 divided by I minus G is going to give me a multiple, assuming that the cash flows are going to grow at a constant rate. I can go into the marketplace and find comparable companies or comparable transactions and calculate multiples and multiply it by our future cash flows to get the value of our company or the value of the shares. So there's different approaches. This is the first time you've seen this. As you work through the book and work through the problems, you're going to be coming across all of this stuff again and again and again. This is just the first time you've seen it. And you'll be doing homework problems and you'll be doing on the exams. Okay? But this is more detailed than I wanted to get into. This is more theoretical, but I think it should help you out. So that's the multiple approach. The discounted cash flow approach Any questions on the multiple? Gordon growth, perpetuity? Any questions? Okay. As you do like 100 problems, you go over this like 15 times, you'll totally get it. I think that the valuation methods and the valuation approach in this class is the most important, because you can take it with you. You can then start to value your company shares. You can start valuing shares that you're buying to build your portfolios. You can start valuing commercial real estate if you're looking to buy commercial real estate. You can start using it, to make investment decisions. If you plan on going into corporate life, into corporations or going into companies, we buy other companies. We buy other company shares. We have to do the valuations. We buy real estate assets. We have to figure out what the value is. We're going to build portfolios of those assets. So the valuation is the first step in building the portfolios. The last method is the discounted cash flow, the DCF. Now, this is just a very simplistic valuation method. The theoretical equation is going to be like that. And I'll walk you through an example of that. So it's the sum of the discounted cash flows plus the discounted cash flows of the terminal value. I'll walk you through an example of this. And I'm just doing it very simple. We'll do more extensive. The midterm, that's all we do is these problems. We do all these valuations. We do all these problems. We do stocks, we do real estate, we do companies. We're valuing. We're like an investment banking firm doing valuations to make investment decisions. So this is a fairly simple valuation approach. It's a 2-year holding period. All right, so the assumption is that last year's, this could be earnings per share, $10, or it could be $10 million, for free cash flow, earnings, or EBITDA. And we assume that the earnings per share is going to grow by 20% from this year to next year. So we're going to multiply the 10 by 1.2. So this is the future value factor that you're using. So when you grow something out, if it's 2%, it's 1.02. If it's 20%, it's 1.2. So we assume that the cash flows are going to grow by 20%. So it's 10 times 1.2 gives us 12. So that's going to be the cash flow in the first year of the analysis. And this is just a 2-year holding period. We're going to be doing mainly 3- and 5-year holding periods, evaluations going forward. We also assume that the cash flow is going to grow another 20% to year 2. 12 times 1.2 gives us 14.4. If you have a calculator, I would pull it out, because in the last class, we were calculating all this stuff using the calculator. So what I would do is I would pull out your calculators, so you can start practicing pulling out your calculators every class. Okay? When you walk into a business meeting, this is what I do. This is my recommendation for you, and you'll see some of the top people do exactly this. They will get to the meeting, they will stake out strategic position at the table. They will put down their notepad, put down their coffee, they will put down their phone, their laptop, their tablet, and a calculator. So they come in totally equipped, okay, to be able to answer anything at any time right there. If you can't do the math in your head, you're going to need the calculator, okay? So that's what you do. You always have your calculator with you. You always have your tablet, you always have your phone, you always have your laptop. And you get it all set up, and you get there 30 minutes early, because it's going to take you 5-10 minutes to get set up. You're all set up, then you can go schmooze and do all your politicking, and then sit down and be totally engaged and add value to the conversation into the meeting. Okay? All right. So then we think that year two's cash flow is going to grow 10% to year three. So what we do is we have a 2-year holding period, but we have to calculate what we're going to sell the company for, sell the shares for, at the end of the second year. So to do that, we need to grow the cash flows out 1 more year. And we don't think the cash flows are going to grow as fast in the latter period than in the earlier periods, because when we take over the company, we're restructuring the company, and we're going to be able to juice the cash flows very quickly within the first year or two. And then it's going to slow down. So we think the cash flow is going to grow from year 2 to year 3 at only 10%. So 14.4 times 1.1 gives us 15.84. Are you all checking them out to make sure that I didn't like mess it up in the last class? Is that correct? Yeah. Okay, thank you. Then what we do is we have to discount those cash flows back to the present. We have to determine the discount factor. We already know in this case, we're buying a small firm, and we expect a return of 15%. Okay, that's our discount rate. That's our expected return. That's our required rate of return is 15%. Or we calculate using the capital asset pricing model, the cost of the equity, and that we came up with 15%. So we use that as the discount rate. Or we calculated the weighted average cost of capital and came up with 15% and use that as the discount rate. Okay? So now what we do in year 1 to discount this cash flow to the present, we take the $12 and divide it by 1.15 to the 1, which is 1.15. 12 divided by 1.15 should give us 10.44. If you guys can confirm that for me, I would appreciate it. Is that correct? Yeah. Okay, so the cash flow divided by the discount factor gives you the discounted cash flow in year 1. Now we're going to do the same thing for year 2. So 1.15 squared should give us 1.32. Is that correct? Okay, so that's going to be the discount factor that we're going to use for year 2 to get the discounted cash flow. So if we take 14 point, oh no, we can't do that yet. Hold on. Hold the phone. What we need to do first is we need to calculate the terminal value. We can't do this second year discounted cash flow because we're going to sell the company at the end of the second year, so we've got to figure out what we're going to sell it for. Okay? And that's going to be called the terminal value. So how do you calculate the terminal value of the TEV? Well, first thing you do is you have to roll out the cash flow a little more year to year 3. We assume 10%, so you have 15.84. Now you have to make a decision. Do you think that the cash flows are going to remain flat forever or grow at a constant rate? The last class said, well, it's a tech company, we assume that the cash flows are going to grow at a constant rate forever. So we're going to use the Gordon growth model to get the terminal value, not the perpetuity model. Okay? So we went ahead and we used our expected return of 15% as the discount rate. And they said, well, we think that the earnings and the cash flows are going to grow at 2% forever. So 0.15 times 0.02 is going to give us 0.13. So the $15.84 divided by 0.13 should give us $121.84 as our terminal value. Does everybody get that? Okay, awesome. Then what we do, the next procedure, is we're going to take the terminal value and we're going to add it to the last year in the holding period's cash flow. So we're going to combine the two. So what's 121.84 plus 14.4? What does that give you? It should give you $136.24. Okay, got it. Now we take the $136.24 and divide that by the year 2 discount factor of 1.32. $136.24 divided by 1.32. Please check, make sure we didn't screw it up. Should be 103.21. So that gives us total discounted cash flow for year 2. Then what we do is we add up the discounted cash flows to get the present value. And the present value should be $113.65. So that is the value that we have put on the share for that company. Everybody follow so far? Got it. So if we're coming up with a value of $113.65 and the current price of the company is $100 per share, should we buy it? Yeah, we should buy it. So our recommendation would be to buy the stock because our intrinsic value is higher than the current stock price. If the intrinsic value that we come up with is below the current stock price, would we buy it? No, we would sell it. And if the intrinsic value is equal to the current stock price, would we buy, hold, or sell it? We would hold it. And if we think that the price is going to go up in the future, can we buy call options on the stock? Yeah. Can we write put options? Can we buy it on margin? Yeah, that would be our recommendations to our clients. Based on our research, here are our recommendations to you. Okay. So that's the valuations. Right. Does that help? Clarify a little? We'll go over it more and more and more. It's a little early to be talking about this stuff, but you guys asked a question, so I thought I'd give you a long answer to a short question. So how am I doing on time? Okay, perfect. Let's go through, pull out your quiz. Okay, and I'm going to start moving through the quiz. So let's go through the exam. And I pull out your blue books and start writing in the blue books. Your pre-test is going to be a study guide. The blue book with your notes in it is going to be a study guide. The class notes study guide. Okay. So you'll have plenty of review materials. So when building a forecast model, what are the first steps, questions that need to be taken? Well, somebody comes to you and says, hey, we need you to forecast, earnings per share growth over the next 4 quarters. What's the first thing that comes out of your mouth? What's the first thing you say? Hey, can you build us a price earnings multiple forecast model so we can forecast what the earnings per share is going to be for our stock going forward so we can forecast the stock price? Can you do that? Yes. Okay, so the first thing that comes out of your mouth is yes. What's the second thing that comes out of your mouth?
I can have it to you by,
Huh?
maybe something like I can have it to you by this time.
Yeah, we'll get to that, but yeah. The question further down is when do you need it? Right. So, but let's go through it. So the first is yes. Second is, what would come out of my mouth is, how would you forecast price earnings multiple? Have you ever done it before? Do you have any recommendations? Do you have any ideas of what factors would be driving price earnings multiples over the next 4 quarters? So you survey the individual right there and you tap right into their expertise. And then you ask them, are there any other people within the firm that I should be talking to that would give me a good idea of what variables should be in the model? So now you bought right into them and you pull them into your project and you're starting to get buy-off by them. It's a little political move. And what's the third question that you would ask them? You just said it.
When do you need it?
What do you need to buy? Okay. And then what would be your fourth question? Am I going to be working by myself? Do we need to hire any consultants? And then the next question is, do you have a budget? Do we need a budget? Are we going to use internal resources, human resources, internal data, or are we going to have to buy the data and hire outside the firm? So that gives you everything. Yes, tying into the expertise of the firm, knowing when it's due, what are the resources that are available to you, and then what's your budget? Okay, you're gonna need to know that. How do you determine the dependent, independent variables? We already talked about that. Either they're gonna tell you, or you're gonna advise them based on your expertise. How do you identify the independent variables? You're gonna talk to them internally, get internal validation, and then you're gonna go outside and look at industry and academic research to determine the independent variables. How many variables do you have in the model? No more than 5. Okay, no more than 5. And you may run into multicollinearity even with 5 variables in your model. So you're gonna have to test for multicollinearity to see if other variables are in the model are highly correlated to each other and to the dependent variable, and maybe decide which one you're gonna have to keep and which one you're gonna have to throw out. If we're experiencing multicollinearity in your model, if you had 2 variables, how would you decide which one to keep and which one to throw out? You would keep the one that's been cited the most in the literature and the research. What is internal validity? Everybody within the firm buys off on your model based on their experience. What's external validity? Cited the most. You're using external sources. And they're going to ask you when you do the presentation on your model, after you've back tested it and you're presenting the results, they're going to ask you who you talk to internally and what research that you used externally to validate and verify your model that it actually works. Okay. All right, and then how much time do I have?
20 minutes?
20 minutes? Okay, I'll just talk about the next one, and I'll go through it, but I'll do more detail. But let me just walk you through and give you some data points. So write really quick, okay? So what is the size of the Federal Reserve's balance sheet? Here's the key. Why do we even have this on an exam? Well, the problem is the financial crisis over 10 years ago basically ballooned sovereign debt and Federal Reserve central bank balance sheets. We've never been here before in history, okay? It was pretty calm, theoretically, over the last 80 years post-World War II. The financial crisis was a total dislocation and disruption to the economic system. Will it happen again? It might. If it happens again, what are we going to do? Well, one, we got to recognize the problem, we got to recognize it and understand it so that we can navigate and understand what we're confronting, okay? So the Fed's balance sheet currently is around $4.3 trillion. Now, if you can write all those zeros out, good luck, okay? Trillions is huge, okay? So 4.3 trillion, it was around 5 trillion. They printed $5 trillion, printed it out of nowhere, out of the air, because they control the printing press to bail out the system. How much money by banks are being held on reserve at the Federal Reserve? It's an identity question. So the total size of the balance sheet, the total amount of reserves held by banks is basically the same. So 4.3 trillion. Okay. What was it prior to 2007? $250 billion. So the Fed basically had a balance sheet of $250 billion in U.S. Treasury securities that used those securities as inventory to buy and sell bonds in the open market through the Federal Reserve Bank of New York, conducting open market operations as the monetary policy tool, okay? So the Fed would buy bonds, drive up bond prices, drive down interest rates to stimulate the economy. The Fed would sell bonds, drive down bond prices, drive up interest rates to cool the economy. That was the major effect. But the fact is that the balance sheet, they only had $250 billion. They now have 4.3 trillion, okay? It's different. And a significant portion of that 4.3 trillion, over 2 trillion of it is federal government debt. So the Fed was the uncle, the rich uncle that you had that basically paid off your debt, okay? And then the other half of the balance sheet is mostly mortgage-backed securities because the financial crisis was a housing-led crisis, okay? It was a housing-led crisis. What has been the growth rate of the money supply since 2007? In 2008 and 9, the money supply grew at 30 to 40%. Currently, it's growing at around 8 to 5%. Historically, the growth rate in the money supply has basically averaged gross domestic product growth rates of 3%. So it just goes to show how extreme the situation was in the financial crisis. They were printing money like mad and growing the money supply to try to stimulate the economy and push interest rates to zero to get people to consume and buy. It was a very desperate situation. Has the Fed hit gross domestic product targets? Currently, the answer is yes. This quarter and last quarter, the average GDP growth rate was around 3 to 4%. Prior to the last 2 years, GDP averaged 1.7%. So well below its target. But they're finally there. Okay? They finally hit their target. The unemployment rate is currently at 4%. The Fed was targeting 5%. So they've exceeded their target at this time. So yes. Their inflation targets, the consumer price index, their target is 2%. Currently the inflation rate is around almost 3%. So inflation is running currently or recently at the target or slightly above the target. So yes. So the question is now that the Fed is recently, over the last 24 months, has hit all of their targets, they've been raising interest rates for the first time in 10 years, okay? Some of these targets are starting to wane now, and the Fed has stopped raising interest rates. It will probably start lowering interest rates at some point, which will have an effect on bond prices, and real estate and stocks. So there's a direct relationship between what the Fed does and the valuations of these securities, which is the basis of the book, okay? But the book doesn't talk a lot about this stuff because the book's out of date. And it's the most recent edition too, and it's still out of date. If we fall into a recession, would the Fed use negative interest rate policy? The answer is yes, okay? The Federal Reserve has used zero interest rate policy, ZIRP, over the last 10 years. Before Janet Yellen left as chair of the Federal Open Market Committee and the Federal Reserve chair, and she has been one of the only Federal Reserve chairs that have only had one term. Most of them are re-elected to a second or a third term. She was the only one that got blown out in her first term. Okay? And I can talk about that offline. So will they use negative interest rate policy? The answer is yes, they will. Which are very desperate conditions for monetary policy, but Jerome Powell and others have already indicated that they would use negative interest rate policy if they had to, okay? You never lived through negative interest rate policy. The Japanese have and the Germans have. The Japanese savers, the people who save their money and buy the Japanese bonds, the JGBs, at negative interest rates, are going literally crazy. There's total social psychosis in Japan. Their culture of saving, and if they have to buy government bonds at negative interest rates, they're basically buying a lower standard of living because they're getting negative interest rates. Okay? If that happens to us, it will be extremely awful too. So what would be the impact on the economy if we went to a negative interest rate policy? It would stimulate it. It would stimulate the economy. It would lower the cost of capital and make it cheaper to borrow for both corporations and individuals, thereby incentivizing into the individuals and the corporations to borrow, consume, and invest more. Okay? So that would be the main objective. What would it have on asset prices? Okay? And remember, we know that the cash flow, T+1 using the perpetuity model, okay? These are asset prices. It's just a simplistic model, and we'll just assume that the cash flow is going to be flat forever. Well, if we go to a negative interest rate policy, it's going to drive down the discount rate and drive up and prop up asset prices. Prop up asset prices. And the capital asset pricing model, if the risk-free rate goes negative, then the whole thing goes down and it props up stock prices. Okay? So negative interest rate will have a positive effect on asset prices and will prop them up, which is what they've done over the last 10 years. Okay? To a level never seen before in history. Real estate prices, and particularly commercial, bond prices, and stock prices have never been this high in history. Okay? What does it do for savers? It makes them worse off. Right? Because I'm buying bonds now at negative interest rates. Okay? The Federal Reserve is trying to prop up bond prices. Right? But if I'm a new investor in these bonds and they're offering negative interest rates, I'm worse off. My standard of living is falling by investing in these government securities. So they're worse off. What about investors? Investors are better off, right? Because if I'm lucky enough to own the real estate and own bonds and own stocks, and the Federal Reserve drives interest rates negative, it's going to prop up the asset prices. Okay? So anybody, the majority of the people in the United States don't own stocks, bonds, or real estate. They don't. Very small percentage of them do. This is the big debate right now. Has the Federal Reserve made things worse or better over the last 10 years by going to a zero interest rate policy? The debate is pretty much coming to a conclusion. Anybody who is in the middle or the lower class that doesn't have accumulated assets, such as stocks, bonds, or real estate, has been totally left out. And there has been the inequality of the separation between the classes is more extreme now than ever before in history. The top 1% of the income distribution now control at least like 70 to 80% of all investable assets in the universe in the United States. So the top 99th percentile owns almost everything in the economy, in the capital markets. And if we go through this again, they will just get more of it. Okay? So major separation, major inequality that has occurred from it. Investors, well, again, if you were lucky enough to invest, you were better off because it propped up prices and you had inflated asset prices. Businesses, well, businesses benefit too, because obviously, I'm using the capital asset pricing model. If interest rates go negative, then my cost of capital is going to go down. I can borrow cheaper, and I can invest cheaply. Here's the other problem that I'll end it here. Here's the other problem with using negative or zero interest rate policy by driving cost of capital for firms down significantly. What the majority of the firms have done over the last 10 years is they haven't invested in plant and equipment or in their employees. What they've basically done is they've taken that money at really cheap capital and they borrowed in the market and took the money and would buy back their stock. So they would issue bonds at very low cost of capital, and they would go in and buy their stock price and prop up the stock price. They would eliminate a lot of the ownership, retail ownership, the shares, and concentrate the shares amongst the employers, top-level executives, and the institutional investors. That's one of the biggest problems. Okay? The other problem that we're facing now is that by driving down the cost of capital, the firms are not investing in employees or hiring employees, they're investing in equipment, in automation, artificial intelligence, machine learning, technologies to substitute labor. So they're using this low cost of capital to substitute labor for capital, which is causing very, very high, or very, very low labor participation rates. There's a whole pool of demographics, particularly people over the age of 50, that are not engaged in the workforce whatsoever because they've been substituted out by automation and machinery, and there's age discrimination coupled with that. So labor participation rates are up to that. So the Federal Reserve, through their unorthodox monetary policy, basically saved capitalism, but benefited the upper class and corporations significantly. and has not really trickled down to the majority of middle class or lower class individuals, not only domestically but on a global basis. What does that have to do with finance? It has everything to do with finance. Everything. So we'll get into, I talked a little bit before about yield curve dynamics, I had a little lecture on that. We went through the dynamic yield curve. Am I out of time? Am I out?
Yeah, a couple minutes.
Couple minutes? I'm just going to blow through this really quickly. Dynamic yield curves, when the curve inverts. When the yield curve inverts, the stock market peaks in less than 12 months, and we're in a recession in less than 24 months. Under D, economic indicators in capital and commodity markets, that's basically what we've been doing when we walked into class. Is where is the stock market today? Where's the Dow? Is it up or down? Why? Where are oil prices? Are they up or down? Why? Where's gold prices? Are they up or down? Why? Where's bond yields? Are they up or down? Why? And where are currency values? Are they up or down? The dollar compared to foreign currency, up or down? Why? And then what I'll do is the dynamic asset class supply demand analysis. That'll take an hour. Financial product innovation engineering, hour. Modern portfolio theory, hour. Derivative trades, we went over those. When I went over the memos, that'll be like 10 minutes, maybe 20 minutes. Technical analysis will probably be about 30 minutes. And then the intrinsic valuations, that's about 30 minutes, although I just went through it. And then we'll work through the problems. The problem solutions are already posted on the website. We'll work through those. Boom, that's the quiz. All right. So thank you, everybody. For those of you that are getting started on the pre-test, work with other people, put those things together, work on them, get a solid foundation. For next Thursday, I'm going to hand out some problems. So take a problem, come in, put it on the board, use this as an inventory every week, come in, put some problems on the board. And then we'll do problems every Thursday. Thank you. Thank you. And if they're short problems, put a couple of them up on the board. Thank you, everybody. Thank you. Thank you.
So we need to do these by next Thursday?
You don't have to do all of them, just study it, and then bring them, put one up on the board.
Okay.
I already gave you the questions and the answers.
Yeah.
But then you just do like a 2-minute presentation. There's a lot there. One or two, and a couple of them. Okay? Then you can use that to get on the board. Next time. Okay?
Do that again.
Thank you.
Have a good weekend.
Oh, thank you so much. I appreciate it. Oh, great. Fantastic. One or two. So much is there, so we'll study it and just come in. It's like a 2-minute presentation. Would you give one to Rowan?
Yeah.
No.
And then, we're team 4, do we present?
Yeah.
Tuesday?
What were you supposed to do today?
I wasn't sure.
Yeah.
So,
Yeah.
yeah.
Just do it, do it on Facebook.
Do a 2-minute presentation on
Oh, you did, awesome. Look at the drill. Yeah. Paul, what's happening?
How's it going?
Looking snappy today, Paul. Are you in my class?
What's that?
Are you in my class?
I have
Oh.
investments right now.
Oh, yeah, cool. All right, take it. Thank you.
Thank you, Professor.
Good to see you.
Nice to see you.
Yeah.